2, 1. We are live. All right, people are coming in for the meeting today. It is a little bit past 1 o'clock on Saturday afternoon, November 20th. And we'll let the people in. And if you want to join in on the conversation, you can either join via Zoom or through the live stream on YouTube. On YouTube, you can participate through the chat. On Zoom, only full-fledged members of the service or trial members can actually access it through Zoom. You can, if you want, access it through the chat or hold on. You can also open up your mic or video and or both. So you have those options. Let's see, I want to close this window. I don't really need that. I don't need that. I do not need that. I don't know. I'm going to do an iPad session today to go over some of the strategies. Hope everyone's doing well. Let's see, we'll close that too. You know, I went through all of this sort of prep of getting all the right windows open and closed and so forth, but apparently I didn't do a very good prep. All right. Now, there we go. There's the iPad. I'll put that over there. We have YouTube going. Let's see, we can make that window smaller. There's Zoom. We don't need that. We can close that. All right. I think we're getting down to it now. How you doing, Chris? The Pothead BTC. That's an interesting name. The retrospective look on being wrong on Bitcoin. See, when you say something in the past, no matter how long ago it was, you are now guilty for that statement forever. Ever! Even if you actually own the thing, or in this particular case, you trade literally more than they have in their entire lives, plus all their friends. But you're still guilty. Always guilty. Letting some more people in on Zoom. We'll give people a few minutes just to come in. Otherwise, I'm going to be continually pressing that admit all button. Yeah, Chris, how you doing? He says, "Oh, great wizard, tell us how high BTC will go this cycle." Well, I'll tell you, before this cycle is almost done, and so the next part of that cycle is obviously a big pullback. And if you've watched any of my stuff, you know that over the long term, I see Bitcoin following a linear progression. And that linear progression right now would put it at somewhere between $10,000 and $20,000. So I see Bitcoin going to pull back at some point within the next, I don't know, 3-4 months to somewhere between 10 and 20,000, then start the whole cycle over again. And then the next one will be much higher if it follows that progression. And then it will do the same thing over again and fall in line with the linear regression since its beginning. And that's the way it is. Now, you can believe it or not, but I only speak the truth here. So that would be a great time to buy into Bitcoin, in my view, when it gets somewhere in the $10,000 to $20,000 range. Of course, any time that it goes up and hits that capitulation point, that top of that first or that initial surge, then the secondary surge, everybody thinks that there's no way you could ever go down. But it will. But anyways, this video, this stream is not about Bitcoin at all. We actually deal in the real world with assets that have actual intrinsic value, unlike Bitcoin, which has no intrinsic value whatsoever. We trade options on the S&P. And the S&P obviously represents the 500 largest companies in the world. We trade a very specific type of option and a very specific event on that specific type of option, using a very, very specific type of strategy, which is, I believe, unique in this industry. Now, there are a lot of people that do what we do in terms of the event part. We trade the last day of expiration of the intra-weekly expiring options on the S&P. I know that sounds like, man, you are just whittling that thing down to nothing. And that's really the root at which all great things lie. The most specific thing, if you can manage and if you can perfect that most specific thing, then you really have something. But there are a lot of people now that are trading this because they recognize the opportunity. The problem is that most of them fall into it the wrong way. They fall into it with one of the many other services that are out there trading that last day of options expiration, which is commonly known as 0 DTE, or the 0th day of expiration. And it became popular, I think, first of all, trading on the 0th day of expiration is not something that just immediately or recently became popular. I've been doing it for decades. I first started getting into it with Apple when they came out initially with the weekly option. Now, I can't remember what that was. Was that like 2007 or somewhere around there? Right around there. And trading that last day of expiration, particularly for weeklies. Even before that, trading it on monthlies was not a new thing either. But trading it on weeklies gave you 4 separate opportunities. Now, the S&P, along with the NASDAQ or the SPX and the NASDAQ futures, they also do this as well, where they trade and have 3 intra-weekly expirations on those options, Monday, Wednesday, and Friday, unless there's a holiday on Monday and Wednesday, then it's either Tuesday or Thursday. Tuesday, Wednesday, Thursday, or whatever. 3 times a week. And that presents an incredible opportunity to take advantage of why you would want to trade on the very last day of expiration. If you trade options, then most of you know that the last day is a bad time because you trade them long. You trade options long, and when you trade options long, that means that your premium, a good portion of the value of your option, is working against you because it's continually decaying. So the value of your option keeps on shrinking. That's if you trade long. If you trade short, it's the exact opposite. The value of your option, although time will be going down, the premium, that premium inside of that option is actually going into your account. And that's where the edge is. And you can do this 3 times a week, trading by selling option premium on that very last day of expiration. As we know, premium decays at an exponential rate on that day. Now, we get 3 of these opportunities a week. So fantastic. Now, let me get to all of the other people, all of the other services that are trading this strategy. And I encourage you to go and look at them. Try them out. Be my guest. It'll be fine by me because I know that after you try them out, you'll see what a farce they are and that this is the real deal. You know, it's not arrogant or lying when you're telling the truth. So please, I'll even name them and I'll tell you what they do. It all started getting very popular. I mean, trading the 0 DTE on the S&P when a woman named Tammy Chambliss came online and she had a webinar where she talked about all the wonderful backtesting work she did and how she's making money on this. And this is her primary way of trading. And she was very, non-threatening type of person, grandma type. And I'm sorry if I'm aging her, or I don't know if she's a grandma, but She became very popular because she was instantly believable because of maybe her persona, I guess, and maybe because of the work that she did, and maybe the way she was promoted. I don't know what it was. However, she promoted this way of trading that virtually every other service out there has now adopted. And apparently because they felt like this is the way you do it, right? How do you trade or sell or trade premium? Most people trade premium or sell premium by employing very low delta spreads or trading the option naked, selling it naked. This is a very common technique in selling puts, for instance. You sell puts against a stock or an index or whatever, and you do it way out of the money. Very, very low, like a 5 delta or something, because you don't want any chance, any probability of being challenged on that position, because if you are, you're going to go into huge unrealized losses. And it will take a monumental effort to come back. Now, what some people will do is they will allow themselves to get assigned, and they'll use something called the wheel strategy, and then, which is untenable in a big index like the S&P, because it's going to consume huge amounts of capital. So you don't want to do that. Now, stocks, that's a different story. It's a little bit easier there. The other way to trade that is to do some other type of option collection strategy and put on a market neutral strategy like the Iron Condor. And still using the same technique where they now, instead of just a naked option, they use a spread, actually 2 spreads, and they come from both sides, right? And they make them way out of the money, very low delta, like 5, 6, 7 delta, or in other words, a 92 to 96% probability of profit. Of course, that's what they're relying on, this thing that's inside of their platform telling them that it's a 95, 96% probability that you're going to profit. So do it. There's like virtually no chance that you're going to lose. Now, what they don't understand is that when you put a strategy on like that, yes, there is that probability. All right. That probability isn't necessarily a reality, and it's based on normal distribution models that are built into your platform, which basically mean that, sure, if you have the perfect normal distribution, this is your probability. And if you can take being in an unrealized loss situation where you're, 1/3 of your account is sitting in the red, and you can hold on until expiration, then you too can make that tiny little bit of profit that's waiting for you. So you could put on, say, $1,000 to make what? $20? $25? Maybe? That is your prerogative. That is the exact strategy of Tammy Chambliss. That is the exact strategy of another service that has a very similar name to mine called ZeroDTE.com. That is the exact strategy of Axe Options. That is the exact strategy of Scott Stewart. I encourage you to go to each one of these and check them out. And I can tell you a little bit about each one of them and why not only is that strategy completely farcical and idiotic and destructive, but each of them do something in their own little way that makes it even worse. So, and I've talked about this a great deal, so I'm not going to go into too much detail other than to say that most of these other people are going down a path that makes absolutely no sense, taking huge risk to make a tiny little bit of profit. And on top of that, as they get into that trade, that what they think is a market neutral trade, as soon as price starts moving left or right or up and down, they are subject to gamma risk. Gamma risk is the rate at which the price of your underlying asset is moving and how it reflects on the price of your option, right? So that gamma risk looks like a Well, a lot like a normal distribution curve. Now imagine you're sitting on the top of that normal distribution curve. You're way up here. And as soon as you move to the left or the right, it's like you're falling off of a mountain. That falling off of a mountain is your unrealized loss, growing and growing and growing. That's what they experience. So what they do is, instead of accepting the fact that it's a 95% probability, they put stops to cut how much unrealized loss that they might have, because it just shakes them to the bone. And they take that 95% probability of profit and turn it into about a 65% probability of profit. In other words, they've increased their odds by 30-something%, or 50% actually, that they're going to stop out and lose money. So on top of the fact that they're still going to experience this unrealized loss, now they've increased their probability by almost 50%, that they're not only going to realize have the unrealized loss, but in fact have a realized loss. So all of it is just insane. So I decided to do it a different way, which isn't unlike virtually everything that I do in life. And that is go down the path less traveled and do something that nobody else is thinking about. And I decided to invert that whole risk equation and say, why does it have to be a market neutral strategy? Or why do I have to treat it like every other market neutral strategy and put myself in peril by putting myself at the top of that distribution curve with this huge gamma risk? Why do I have to accept taking 10-to-1 risk to reward? I would rather do 1-to-10 or 1-to-15 risk to reward. That sounds much better to me. Should sound better to you too. So that's what we do. We also do premium collection strategies. We do not, under any circumstances, treat those strategies as market neutral strategies. We treat them as directional strategies, because the market is hardly ever neutral. Ever. Maybe 3 or 4 or 5% of the time it is. But even then, there are ways to profit without putting yourself through that gamma risk. So instead, what we do is we take these premium collection strategies and put them out of the money. Does two things. One is it flattens our probability curve, that gamma. It just totally flattens the gamma down to virtually nothing, so that regardless of which way price goes, we experience hardly any unrealized loss and, in fact, realized loss. Secondly, it puts us into position to take advantage directly of the premium decay, because if we're sitting on that curve, it's like being on a boat at low tide at the dock and high tide's rushing in, and you just have to sit there and it will come in. Or if you're maybe further out to sea and you want to realize it, you can start coming towards the dock, and then it would still rise and you would be realizing it even faster. I don't know if that analogy works, but that's kind of like what it is. The other thing is, so here, in that situation where we put our strategies way out of the money, that's the one benefit, that we don't have the gamma risk. And gamma is actually in our favor if prices are rising. If price, well, kind of. Let's back up here a little bit. I'm trying to get a cogent thought here. We also, by putting it way out of the money, we're taking much less risk on, right? For potentially much more reward. Now you see the difference. Instead of taking huge risk out here to come down to tiny little reward, we're going out here and taking little risk for potentially huge reward. So we never really take any big risk. However, we can still make money without the gamma anxiety by not moving a little bit away, or even moving a little bit forward. We can make tremendous profit. Usually on average between 150 to 200% of the original risk that we took. All right, so that's the majority of the time, maybe 60, 65% of the time. where the other service during that entire time is doing exactly the opposite. Huge risk for a tiny bit of reward. And on top of it, that reward that they're going through, they usually cut it in half. You've heard a lot of them talk about how they cap their profits at 50% to get out. And that is, in fact, to minimize the opportunity that they're going to experience that gamma risk or falling off the edge of the mountain. So not only are they taking that huge risk for the tiny reward, but they cut the reward in half. All right? So that's obviously something that we don't do. We don't care about the risk. In fact, it comes down to a different mode of realization of a trade. Most people, their realization of a trade and what they're doing most often is doing something called managing their risk. They manage their risk because if they didn't, in other words, if they didn't manage how much they're going to lose, they would lose a lot of the time. Instead, they have to concentrate on how little they can possibly lose. They're not even thinking about winning, but they think that by managing their losses, that somehow their wins will add up enough that eventually they can overcome the odds and make more money. Now, we all know that most people that are trading this way are losers. And I'm sure that if you were trading this, I'm sure that you were trading this way for years and you were a loser. Sometimes you won, sometimes you might have gone on streaks, but eventually you gave it all back and you lost. Don't tell me this isn't you. It is. And if it isn't, then you were lucky. End of story. The odds, the studies, the statistics don't lie. It's possible that you were in that 2 to 5% that were winners, but very unlikely. Right? Otherwise, you wouldn't be here. Right? All right. So that's the way they do. They are managing risk. We never manage risk. As a matter of fact, the fact that we put on so little risk means that we never have to manage risk. As a matter of fact, it is not even a thought in our minds. And this is one of the things that most people new to this service come in and say, well, what happens if we're out of the money or we go into the negative, Ernie? What do we do? I say, nothing. We do nothing. As a matter of fact, there are some cases where we do a little bit that will give us a chance of making a lot if we go out of the money, but we don't try to take the risk off because we've already defined it. It's so small, we don't care. Most of the time, it's going to go the other way, and we're going to make 2-3 times that risk. Sometimes we can make 10, 15, 20 times that risk. So why would we be managing the risk when what we really need to be managing is the profit? That is what this service is all about, how we can maximize our profit in these situations. That is what we do. That is what we do that is fundamentally different from what everybody else does. So if you're new to this service, then just get that through your head. We do not manage risk, we manage profit because we don't have to manage risk. We do not manage risk. In putting our strategies on, we make sure that we do not have to manage the risk. The only way in our strategy that you can be putting yourself into a riskful situation is if you're just overwhelmingly greedy or experiencing FOMO or whatever it is, you've gone out of your mind and you decide to just completely blow up and trade way too big. Which is basically what everybody else does anyways, as a matter of course, because it's the only choice that they have. But here you have a choice. And to make that choice, to go back or regress, is idiocy. It's insanity to do that. You would have to be a fucking idiot. Sorry for the language, but really, you would have to be a fucking idiot to do that. If you're trading the other way, you just have to be a fucking idiot. But you have an excuse. You have the excuse of ignorance, right? But once you know a better way to do it, if you revert back to that way, then yes, you are a fucking idiot. Right? Sorry. Sorry for laying down the truth of what you are. Now, I want to say that I'm not putting or elevating myself onto a pedestal here as if I have all the answers, because I was also a fucking idiot for decades. It took me 10 years of mentorship and pounding in my head and being in the industry serving the people that are actually making money for 30 years before I even understood or realized that I could do that too. All right? So I am no different from you. The only difference is that I've come full circle to a point where I've come to that realization of what is the right way to trade. The right way to trade is to do what the professionals do. There's two ways that they make money. Only two ways that the professionals make money. There are some that are value investors or whatever, but I'm talking about people that are trading on a daily basis. There are only two consistent winners in the market with two consistent strategies. One is pure arbitrage. Who's doing pure arbitrage? Market makers. Market makers are doing pure arbitrage by playing both sides of the equation. They have a guaranteed profit. That is the difference between the bid and the ask. On top of that, they sweeten the pot by getting a commission when they add to the liquidity of the market. All the major investment banks, that's how they make the majority of their money. There is a second way. Now, obviously, being a market maker is not available to us. The second way is that they sell premium. There is another industry out there that is one of the biggest industries in the world that is well known as the most lucrative and cash-rich industries in the world that also sells premium. They're called insurance companies. Traders that sell premium are the other, professional traders that do it in the right way, obviously, are the other people that exercise a strategy that actually has edge that makes money. Professional sellers of premium make money as well. That's what we do. We sell premium, but we don't do it the way everybody else is doing it. We don't take ungodly risk for tiny little profit. We do the inversion of risk. Take tiny little risk for huge profit. We know also that, and this is, look, everything that I'm telling you is what everybody in our service that has been with me now for the past several months has heard this all over before, but it's worth repeating and it's worth telling them because sometimes, you I don't know, go off the farm, as they say, and you have to reel them back in and say, man, just focus on what we're doing. It's so easy. But most people don't do that. That's why we have such an unbelievable attrition rate here. Virtually nothing. I think out of 300 people over the past few months, I think I've lost 4 or 5 people. And all because they either didn't have the time to trade or some other issue, or maybe they just were too pig-headed to get it. But people, once they get here, they decide to stay. And that's because we make money consistently. And we do it in another way that is against the grain of what the market is telling you. What all the, the charlatans and advertisers and educational institutions, which are attached to the brokers, by the way, because they're actively trying to get you to trade in a way that is traditional, not because they want you to make money, but because they want you to create transactions, which I call the broker narrative. Now, this is what we do. We sell premium, and on the last day of expiration, when that premium is decaying or coming into our pockets at the fastest possible rate, and we do it by putting on asymmetric trades, small risk to large reward, and we're not trying to do this narrative that I'm just talking about, trying to create an income. The whole idea of trying to create an income out of a market with the assumption that somehow you're able to wrestle that market and force it to comply to you to give you a regular amount of money every week is insanity. Markets do not do that. They do not behave that way. They do not give you that kind of opportunity. Instead, we are opportunistic and we have a growth strategy. We limit our loss so our drawdowns are virtually nil, and we wait for the market to come to us and give us that big profit boost. And so we are growth, and we grow in spurts like that. Sometimes those spurts come slow, sometimes they come fast, sometimes they don't come at all. So we just sit back and wait. We don't have any control over the rate at which the market decides to give us opportunities. All we can do is put ourselves in the right place at the right time with the right measure of risk to reward and play off of the advantages, the edges that we have that are inherent in that strategy, and wait for the market to come to us. That's how we make money. And I can say we make it consistently. We don't always make the same amount consistently, but we make money consistently. Sometimes it's slow, and then other times we might pin a trade, and instead of making that 150, 200% on a trade, we make 1,500%, 2,000%. It's happened many times. Now, one of the limiting factors for us, the thing that kind of regulates our ability or the probability that we might make the bigger score, which only happens on average about 10 or 15% of the time, is where the whole market is in terms of volatility. We have this idea of the volatility regime. And there is a sweet spot in the volatility regime. And we can look at it in the VIX, we can identify it, and through experience, we know that it's somewhere between 17 and 34 in the VIX. Something in the middle is much better than something on the edges. To the higher end of that regime is better than to the lower end of that regime where we are now. However, we can still make money consistently. It's just a little more effort required. But when it gets up into that mid-range or the mid to high range, it's really, this strategy is like printing money. But as close as you can get. It is as close as one could imagine to the market maker's arbitrage. When we're here, it requires a little bit more effort and how much profit that we can take and how efficiently we can take it. So hopefully that this whole thing gives you a very ambiguous idea of what the strategy is, but at least a feel for what it's like to be this type of trader. Let's see, Drew says, I hear you talk about this a lot. Assuming we started with a debit, how do we still profit if price stays the same or even moves away a bit? Well, if you're, let's say, okay, let's do this. Let me turn on the iPad and I will demonstrate it. Turn on the iPad. Go to the iPad window. All right, and we'll go to this program here, which is really cool. All right. And so the first thing I'm going to do is I'm going to draw the traditional profit graph that you would see in your options trading platform where you can visualize the strategy. The strategy that we use primarily is the butterfly. Now, there are three different variations of the butterfly that we use. I'm not going to go through all three, but I'll tell you briefly. There's the symmetrical butterfly, and the reason why we use the butterfly is that it is one of the best options collection strategies out there because it concentrates all of the value of the premium in one strike. It also has two short strikes at the apex of it, and then two long strikes, which is called the wings. And those long strikes cap our losses. If you were to put the butterfly on traditionally, and that is at the money, you would put the short strikes, then you are doing the worst possible method imaginable to try to collect money off of a butterfly. Right? Sorry, but that's just the way it is. Better to do it out of the money and treat it as a directional trade because it does a number of different things. But let me just answer Drew's question by first. All right, we'll pick that pen. Creating the graph. So this is minus, this is plus, and then this is your price. So price. All right, and then over here is profit. All right. And let's just say that at the money right now is right here. So wherever we are in the market, where's the market right now at about 47.10? I don't know. Let me just check here, just so that we have some sense of realism. Currently, the futures market for the E-mini S&P closed yesterday at about, let's call it 4,700. Let's just call it 4,700. All right. Now, what we're going to do is we're going to put a butterfly on. Now, I said that there are 3 different types of butterflies. There's the symmetrical butterfly, where a butterfly really is just 2 spreads of one type, either puts or calls. So it's either all puts or all calls. And you're either a short spread and a long spread, a short put spread and a long put spread, or a long call spread and a short call spread. And they'll each share the same short strike. All right. So let's say that we're predicting that price is going to go down. So that means that it's going to go below. Now, if it's going to go below, we're going to use the put spread so that all the strikes are out of the money. We don't want them to be in the money. If we were going to predict it's going to go up, then we would use the call spread because then, again, all the strikes would be out of the money. That's not so important with the SPX because the assignment on an SPX is cash settled. On a futures contract, the assignment is actual futures contract. Now, again, it's not really that important because we never allow it to go all the way to expiration, but some people are still scared that they're going to allow something to go to expiration, and it will. And so, they get all flummoxed over that. So it's just easier this way. You never have to really worry about pre-assignment because these are European-style options, and the only time you can be assigned is after the contract is expired. So what we do is we put on a butterfly, and it'll look something like this. Let's see. All right. Huh. Why am I not? Oh, somehow. All right. It'll look something like this, where our short strikes are like right here. Some distance from at the money. And the further we can put that away from at the money, the higher up the butterfly will sit and the less risk, because our risk is actually, let me choose a different color. This is our risk. This is our potential profit. Profit, risk. Now, if we were closer, right, this butterfly would sit something like this. Let me choose a different color. Let's say that we put it right at the money. This butterfly would look like this. See the difference? Much larger risk, much smaller profit. We don't do that. For good reason. So let's go back and we'll undo this. Where's the undo? I haven't used this I got to use this program more often, I think. Let's try this. All right. Anyways, we'll continue on. So let's take a look at, we'll just do another chart. We can create it very quickly. All right, and then we'll use something like fuchsia as our actual profit line when we put this on. Now, when we put this strategy on, our real-time profit line is going to look something like this. All right, and we're going to say that price is actually right here when we put it on. All right. I'm sorry, that's our short strike. Price is actually right here, right? Now, this isn't exactly what I wanted to show. Sorry. I'll do it one more time. Just make it very clear. All right, there we go. Now, let's say that we just stay right here. Price stays right here. As time goes on, this purple line is going to change. It's going to start building and going up in this direction. So what will happen is that it'll start doing this. Now, if you look, there's a difference between where we are at the price, where it started and where it is now. That's how you make money by price not doing anything. It will rise. Now, eventually, it's going to continue inwards or towards the center of this strategy, and it's going to be like this. So if it stays there forever, if price stays there forever, eventually you're going to be out of profit. But for some time, in the initial stages of your trade, you're going to be increasing in profit if you do nothing. If you move anywhere towards price, let's use green to illustrate that, then you can see that not only are you increasing in the zero case line, but as time is moving on and this purple line is increasing, so is your profit making potential. So in fact, you could end up right here sometime during the day, let's say around 12 noon or 1 o'clock in the afternoon, and be substantially in profit, sometimes as much as 2, 3, 400% greater than the risk that you took on, without ever getting inside of here. That is the majority of the case. Most of the time, this is where we make our profit. About 35% of the time, we actually get inside of the profit tent, inside of the big tent of the inside of this. We get inside of that. And when we do, we profit even more. Sometimes we can hold it through expiration. And we're hoping that we get as close to the center strikes as possible, because that's obviously where the maximum profit is. We can get within 5 or 10% of that about 10, 15% of the time, and do what we call a pin the trade and make tremendous profit, usually something on the order of 800 to 1500% of the risk, the initial risk that we took on. When we're outside here, we often, this is the majority of the case, we're anywhere from 50 to 300% of the risk. When we're inside, it's usually a lot more, usually 500 to 1,000%. And when we get into this area, then we're talking about much bigger profits. Now, there's a problem with being in that area. And then as you get into later parts of the day, and that is that your gamma risk is increasing dramatically. And what that means is the gamma risk, let me just do another chart and I'll show you what gamma risk is. So let's say that you're later in the day and you're sitting right here, as opposed to the early part of the day, you're right here. What do you notice that's different about these two purple curves? Well, the thing that's different about those two purple curves, obviously, is the height of the middle of that curve. One has much steeper edges. The other one has very shallow edges. That steepness is your gamma risk. So as you get further on in the day, your gamma risk is increasing dramatically. That's why at the end of the day, especially in the last few minutes, any price fluctuation back and forth this way can dramatically change your potential profit for that day. That's why there's some portion of the day as you're going on where you have to decide, from time 1 to time 2 to time 3 to time n. You have to decide whether or not now is the best time to get out, because you're working against time, gamma risk, volatility, all these different factors that are moving. It's actually a 4D equation that you're judging. There's no calculation here, because price is going back and forth. Events are happening out in the market. What isn't changing is the rate of decay. Well, even the rate of decay might be changing, because if price is going down, that rate of decay is actually working against you. If price is going up, then that rate of decay is increasing. So even that has some input as to what you're going to do. All right, there's another question from Drew. Do you have any observations from the last few months whether people who take the base hits 100 to 200% make more or less money over time than people who wait for the bigger returns? We only go for the, see, there are different ways that you can approach that, and it really depends on how big your account is. If you have a small account and you can only afford to put on one position, then you're going to choose a time to get out that's somewhere in the middle, unless the conditions are perfect for you. Perfect conditions would be conditions when the volatility regime is in a place that is very, very good for you. All right. So I said that the best volatility, or what we call the Goldilocks zone, is between 17 and 34 on the VIX. If we're sitting at, say, a VIX of, say, 25 to 30, that is like the primo conditions. And there are a number of things that set up in the market that make your ability to stick with a trade much greater. Now, one of them is that when you have higher volatility, you're able to create much wider butterflies, much wider. When you can create much wider butterflies, your gamma risk is decreased by a tremendous amount because the profit curves are now wider and you have a wider range at which you can operate. And so there's more flexibility in how much price moves up and down, and giving you more time to sort of judge whether or not price is going in your direction and you can stick with the trade longer and possibly even pin a trade. That's why when volatility is higher, not only does it allow us to create butterflies that are sitting higher on the profit loss curve, but also wider and closer to the money. All of those things are true. Those present the best possible times to trade this strategy. Right now, when volatility is very low and gets down below 15, 16, 15, 14, the opposite is true. We need to create narrower butterflies and push them further away from at the money in order to get the kind of risk to reward that we're looking for. And that increases our gamma risk. So that is why lower volatility times are harder to trade than higher volatility times. Now, this seems counterintuitive to most traders. That's because they do not understand the dynamics of trading options. When you hear these things that professional traders are talking about, oh, I wish I had some volatility, this is why. Because volatility benefits them. It puts all of the edges in their favor. For the average trader, it does exactly the opposite, because volatility to them means fear. It means that price is going to be moving erratically and they can't guess which place to put it. And that's the problem, that they're trading in a way that is not conducive to the market conditions. They're trading in a way that the brokers who have financed all the education in the market to teach traders how to trade was not given to them in good faith. In other words, the trading that you learned about in terms of technical analysis and all these patterns and all this other crap and indicators, they were given to you for one purpose only, and that is to encourage you to make lots of transactions, because that is how the broker makes money. Every time you push that button, they make money. They do not make money if you make a lot of money, or if you're in positions for a long time. It costs them more money to support you if you're a winner. It costs them less money to support you if you're a loser. So that's what they do. All right. Let's see. We'll admit Brad. Brad is late to the party. That's okay. All right. Are there any other questions? No other questions. Amazing. Let's see. Huh. Can someone in the Zoom, can you, oh, there we go, Chris. Hey, Ernie, can you explain when we take off the spread for profit on unbalanced fly or not? Okay, so before I get to that, Chris, let me explain the other types of butterflies that we trade. So there are three different types of butterflies that we trade, and then there are a number of strategies that we employ or methods that we employ in managing those butterflies. So let me start by bringing up another screen, and then talking about the three different types of butterflies. Oh, I didn't want to do that. All right. So the butterfly that we've been talking about is the balanced butterfly, where the spreads on either side of the short strikes are of equal width. All right, and that looks like this. Now it can be wide, it can be narrow, whatever. It doesn't matter. Equal width. And so the risk on both sides is exactly the same. It equals. Then there's the broken wing butterfly, where the spread on either side of the short strike are of unequal width. So it might look like this. And why would we do that? We do that if we're sitting here and we think price is going to go down. We want as little risk as possible, and maybe we think that the odds of price moving all the way out to this area are very small. So we put the risk closest to us, and that allows us to make money as the profit curve grows, and the profit curve will look something like that. That profit starts growing on this side faster. So that will increase our odds of profiting by using an unbalanced. Sometimes the balance is the best way to go. Sometimes with very low volatility situations or unknowable situations or situations where our analysis of the market or the underlying market structure, we use volume profile to determine that, are very, very difficult. And so we'll use something called the unbalanced butterfly. The unbalanced butterfly, where these butterflies are one long, two shorts, and one long, and then the balanced one is where the long and the short, the two longs are equidistant from the short. The unbalanced butterfly is one long, three shorts, and two longs. Now we can control the width that they come out at to make it look like a balanced butterfly, but it's still made up of what is essentially a regular symmetrical butterfly or a normal butterfly, 1, 2, 1, plus an additional 1 by 1 on one side. So in other words, like an additional vertical that's been attached to one side. The reason why we do this is really twofold. The biggest reason is that now instead of having 2 short strikes, we have 3 short strikes for collecting premium. The other reason for doing this is that from an adjustment point of view, it allows us more flexibility. We can take off at some point just the spread, the vertical spread, the additional spread, or we could take off the short strikes and leave the long strikes. Those are 2 adjustment possibilities. You might ask, well, why would we do that, Ernie? That, then it's not a butterfly anymore. There are cases, we only do this where we remove short strikes when the strategy has apparently gone so far against us that we've achieved max loss, and there's really nothing that we can do other than look at it. But there is something that we can do that will give us the opportunity in the event that the market decides to move back to to profit tremendously. All right, and I'll show you that. So we're going to focus on this area right here. All right, so I'm going to blow that up. Right there. So let's say that price went this way against us. And if we looked at the P&L line, it looks something like this. And now we're right here. And so we're at max loss. It's not a big deal because we were planning on that if we go to max loss, the risk is so small we don't care. And from here here it'll look like this. And we're sitting, let's say we're sitting, price is sitting right here. We look at that and we say, well, you know, we've moved so far this way that it, you know, no matter what happens, if price stays here or to the right, we're going to lose. But what would happen if we were to remove the short strikes and just leave the long strikes on? In the event then that price might come back this way. Now, we don't know it's going to come back that way, but it could. Well, we could remove the short strikes. And what that would change in our strategy is something that looks like the following. I'm going to use a slightly different color. I'm going to use red. No, like orange. And when we take the short strikes on, our new P&L is going to look something like this. That's going to be the strikes that are left over after you've taken the short strikes off. And so now, our new, well, that's the orange is at expiration. Our new at expiration, once we take the short strikes, looks like that. And now our new profit curve looks something like this. Notice that it's going up faster here than the old profit curve. So now if price comes down, we all of a sudden start making profit faster than if we had left the short strikes on. That's the adjustment that we make with the unbalanced. And that gives us that opportunity to have now use 3 short strikes to pay for more of the strategy, and then have an additional long strike to increase. It works just as well with just the regular butterfly, but with the unbalanced, having those extra contracts works even better. So that if price does, after maybe near the end of the day, starts going, it reverses, gives us the opportunity to profit dramatically. And we did this twice last week. We did it this past week. We did it Monday, and we also did it the Friday before. I think it was Monday and Friday. But both times we used this strategy and profited dramatically. We tried it again on Wednesday, and it worked. I think it was Wednesday. Did we use it 3 times in a row? I can't remember. We tried it yesterday, but it didn't work. It was a losing day. So, no big deal. Nothing ventured, nothing gained. Jeffrey's asking, with the 132 unbalanced butterfly, is there less gamma risk if you structure with the one long closest to the market and with the larger distance between the long and the short? It depends on how you structure the overall butterfly and how asymmetric it is. But in general, the gamma risk isn't going to be much different. And in the case where we're way out of the money, where we think it's going to be a losing trade, the gamma is not an issue. Actually, gamma will be working for you as price reverses. But if you're near the end of the day and you're in an unbalanced butterfly, the gamma risk between an unbalanced and a regular is not going to be significantly different. You're just going to know that you're going to have increased gamma risk as you're near the short strikes and time is running out, and that overall P&L is getting steeper and steeper. Gamma risk is getting bigger and bigger, and you have to make a decision to get out. So there's not much difference between whether it's unbalanced or balanced or symmetrical. There may be a small difference, but not enough for you to sit there and say, well, I'm going to take a different strategy. It's all the same strategy. You get near the end of the day and the gamma risk is getting more, and you have to decide when to get out. It's not going to be, well, if I have an unbalanced versus a broken wing versus a balanced, I'm going to do A, or I'm going to do B, or I'm going to do C. It's not like that. It's all the same. You're going to do the strategy, which is get out when you have confidence that you can get out with as much profit as you can. All right. Hopefully that makes sense to everybody. Any further questions? No more questions. Holy crap. How can that be? So there was this other question from Drew. Do you have any observations from the last few months whether people who take the base hit at 0 to 200% make more or less money over time than people who would go for the big thing? So the answer is to that is that sometimes you take what you can get. You don't sit there waiting always for the big thing, because the big thing happens 10 to 15% of the time. It becomes obvious sometimes that you have the big thing, the what we call pinning the tail on the donkey, right? You get very close to that short strike. But you can increase your odds of hitting that pinning the tail on the donkey if you have multiple contracts. And so if you have multiple positions or tranches, then you can secure a profit when you're outside of the profit tent and take the majority of them on, and then let the last few ride, the last position or the last couple of positions ride without risk of losing any money in that overall trade and increasing your odds of possibly pinning the trade. So you have a slightly greater chance of getting the pin trade if you have multiple positions, but not that much more. But you can increase your odds a bit. If you have just one position, you just take what you can get. You get in, get out when you think you can. Some people have a little bit more nerve than others, and they hold on for a little bit, but really comes down to our analysis of the underlying market structure and what your level of confidence is. It shouldn't be, most people that are getting out too early are not looking at that. They're not looking at the underlying market structure. They're not looking at the momentum of the market. They are just, they fear losing all their money or losing the potential profit they're making, so they get out early. And I don't understand that. There shouldn't be any fear. We have 3 opportunities every week. We have plenty of opportunity to do this. Our risk is very small. Just hang on for a little while longer. Once you start getting acclimated to this way of trading, it becomes easier. Let's see, I'm going to go to the big head here. because you no longer have this risk to worry about. You're just managing that profit. You can make clear-headed, more logical, reasoned decisions. And sometimes it just takes experience before you get to that point where you can have a little bit more nerve to stay with a trade a little bit longer. And the reason for that is that you start being more of a student of the underlying market structure and understand where the market is showing support or resistance based on the volume profile. So that gives you that level of confidence, whether you should hang on or not. That's what it really comes down to. Enrico is asking, the coming week, are you going to do 0 DTE trades Monday and Wednesday? Yes. But it looks like Thursday and Friday may not happen. It looks like there's only a half day on Friday. So probably not on Friday. But definitely Monday and Wednesday. They are both full trading days. All right. Andre's asking, what happens if the market continues to dramatically sell off after you've taken off the short strikes when already at max loss from the butterfly spread? Will the naked long strikes that have unlimited risk to the downside? They don't have unlimited risk to the downside. I'm not sure where you're getting that. So the only risk that you have when you take the short strikes off is however much extrinsic value is still left in that short strike. Typically, we take it off when there's only 10, 15 cents left of extrinsic value. So if your original risk was 100, let's say, and then you took the short strikes off when they only had, say, 10 cents left of value, then the max that you could possibly lose on that trade by taking the short strikes off is the 100 plus the 10, or 110. That's it. So if you wait to take the short strikes off after they've depleted all their value, in other words, they've actually profited for you underlying, they've already built in the hedge against the long strikes. Now you're taking them off, so that can never be taken away. Ever. So there is no additional risk or very minor additional risk by doing this, if in fact it doesn't reverse and keeps on going opposite your direction. Cool. All right, let's see. We are at, wow, an hour and 15 minutes. This went way over than I anticipated. If there are any more questions, ask them now. Otherwise, I'm going to wrap things up. I'll give you a couple seconds here to formulate a question. If you don't have another question, that's fine. We will be resuming. This particular video will be edited down, so it will be less than an hour and 15 minutes. Take all the ums and ahs and waiting and stuff like that. Should get it down to under an hour. And then it will be posted on the members' website for you to watch later. All right, no more questions. Great. I hope everybody has a great weekend. And Sunday we'll be out there looking at the futures market Sunday night. Futures market, as you know, opens up on Sunday night, so there might be an opportunity. I don't know. Otherwise, it'll be Monday morning. Thank you. Take care, guys.